Good afternoon and welcome to this week's edition of Halftime Talk in a new season 4 of the show. Delighted to be back after the summer break to welcome Valery Chow, President, Head of APAC Gas and LNG Research for Wood Mackenzie. Welcome, Valery.
Thanks, Sean. Thanks for having me on the show.
Absolute pleasure. I mean, since we've been away over the break of the last month or so, the sentiment generally appears to be in the oil markets, one in which we've moved from supply concerns to demand destruction concerns, and generally the sentiment around that. At the same token, gas has moved on and on and on. What's your takeaway through the summer and what trends we're going to take out of it?
Yeah, thanks, Sean. So I think maybe the first point to talk about is, just the macro outlook today. I mean, clearly, I think we see global demand growth under significant pressure, right? Partly due to price inflation, and that's everything from food to energy to housing to transport. China, of course, remains resolute with its zero COVID strategy. And, Europe is obviously struggling with a staggering rise in gas import costs today. So I think if you look out there, the synchronized slowdown in economic growth across the US, Europe, and China certainly is weighing on our GDP outlook. And we can, in fact, project that to fall off to something around 2.8% this year. And that's coming off from 6.1% last year.
That's globally?
So I think that's globally, indeed. So I think what we've seen also in the second and third quarter of this year is, kind of price-led demand erosion, particularly across the transportation fuel sector. So this is kind of talking about oil sector first. Now, retail fuels obviously have come off the June highs, but that's obviously created a knock-on risk impact, right, in terms of economic contraction. And we do expect liquid demand this year to just grow by maybe 2.5 million barrels. So we're thinking something around 99 million barrels a day by the end of this year. Now, on the supply side, I think that's probably one of the brightest spots that we've seen. We think that liquid growth, for example, could go from 96 last year to maybe 100 million barrels by the end of this year. And that's largely on account of OPEC plus crude capacity coming through. The bulk of this, of course, coming from the core Gulf states, Saudi Arabia, the UAE, and Kuwait. And, despite some struggles, I guess, among the group in terms of reversing some of the production cuts over the previous years, we've actually seen output grow, right, as a whole. And our view is that, kind of Russian production will continue to largely hold up. Even today, it's kind of producing around 10.8 million barrels, versus, let's say, before the Russian invasion, you're kind of hovering around 11. And in some ways, they have found buyers, right, from let's say, China and India who are stepping up to fill the gap. I think
we have OPEC Plus already talking this week about starting another cutting cycle. Your thoughts on the outlook for that? Will it be meaningful when the reality is their current quota production level is fictional? They're about 2 to 3 million barrels above on the quota to actual production. So any cut is kind of a facade, is it?
Well, I think indeed, but I think you're already starting to see perhaps the price impact, right, of these talks, right? I mean, obviously Brent prices kind of bottom out a few weeks back, and in the last few days, right now you're seeing that starting to pick up now. So I think in some ways the jawboning that's going on, at least from Saudi Arabia, is starting to have its impact on the market. And I think another thing to maybe factor into this is that towards the back end of this year, right, as some of the EU potential oil import bans start to go into place, our view is that there's a potential for price rebound. Because that's, in the short term at least, because I think the reshuffling of global oil flows, right, will cause some, kind of upward pressure. And in some ways, we do expect the market to potentially stabilize kind of in the 105 to maybe 110, range over that period of time. Now, having said that, I think we are obviously in an environment where, kind of recessionary fears are very much in the air. And,
what do you think about the Saudi minister's comments on that? He said there's too much language around demand destruction. The reality is there's no destruction yet. The U.S. economy, half the states in the U.S. have just unemployment under 3%. I mean, record unemployment. You have this crazy duality of talk about dark clouds, but I'm still standing in an incredibly bright sunlight.
Well, I think my personal take on that is that things like employment, for example, at least in the US, that's a lagging indicator, right? And I think if I'm looking forward, I think the forward view is not quite so rosy, in my opinion. I think you're already starting to see some corporate layoffs like happening in the US, even in the tech sector. The US consumer is obviously doing quite badly now. Credit card debt is rising very quickly. Interest rates are going up potentially, right? And energy prices remain extremely high, even in the US, right? With the rise in heavy hub prices, that ultimately that bill shock is going to manifest itself somewhere, and therefore acting as a further barrier to the US consumer. And then I don't need obviously to tell you about the housing market, right? In the US, it seems to have really fallen off a cliff. So in some ways, I think that, in my view, again, will ultimately have a knock-on impact, maybe not quite in the summer, but certainly going to the back end of this year and more so into the 2023.
Where does that leave? Let's talk a little bit about the sort of oil and gas industry in terms of the just the field production opportunity. I mean, it's a bit of a boom, certainly here in the Gulf. Every oil service company as field operator is 24/7 added, but yet the shortages of equipment, of talent, as you hear in the US, the ability to recover the production lost in the shale patch, that generally the industry has a lot of opportunity, but is struggling with resources, supply chain. Your thoughts on what a restriction that is on recovering production or expanding new production?
Yeah, so I think that's a great question. I think we've certainly seen a lot of price inflation come through the upstream industry in particular. And then bear in mind that, certainly during the pandemic period, a lot of capacity was cut. And I'm not talking just necessarily about equipment, but certainly also in terms of human capital, right? A lot of folk were kind of laid off, unfortunately, and a lot of these talents not necessarily going to come back. And if they come back, it certainly will be at much more elevated prices. So I think that's kind of one major struggle. I think at the same time, I think investors as a whole have been, the oil industry as a whole, right, has faced this kind of conundrum, certainly over the last few years, where on one hand, I guess demand is kind of picking up, right? And clearly there are shortages especially on the gas side of things, right? But at the same time, a lot of the ESG type considerations have been holding back investment. So outside perhaps the Gulf states, we've not seen a lot of at least a major tick up, right, in kind of potential investment. And that's kind of the other side of the equation. Now, kind of going forward, I think these two tensions are going to kind of weigh against each other. On the one hand, potentially, a lot of EPC activity going on, right? In terms of, especially, let's say, new liquefaction plant, for example. But at the same time, I guess, if we are kind of, the global macroeconomic outlook is fast deteriorating, I think that's certainly going to, give pause for concern, right, for potential project developers on just how fast and how quickly they want to proceed with these projects. I mean, in some ways, I've kind of lived through 2013, 2014, right, where we basically saw, prices kind of shoot up to record levels and then only to come back down very, very quickly. And I just kind of wonder whether, in some ways, the world's currently on the precipice of that again.
Looking at the other big story coming out of the summer, of course, is the 6-month anniversary of Russia's war in Ukraine and the big disruption that has created in Europe, obviously, and in the world in general, and of course, most notably in Ukraine, and for the people of Ukraine under the bombs, the biggest impact there. But I wanted to talk a little bit about the change in energy flows that is, and look at an Asia versus Europe situation, particularly around the competition for gas as we go into the winter. Gas prices are at these unbelievably high levels. Where does Europe and Asia coexist in their competition, particularly around LNG?
Yeah, so I think that's, I guess, certainly an area of specialty for me. So definitely, this is something that I love talking about. I think the bad news is that in contrast to the oil markets, we really see no respite for global gas and LNG markets at present, right? So TTF prices obviously have been skyrocketing since the middle of June, I think, and largely in the aftermath of the Freeport outage. But also in the intervening time, right, we've had this massive European heat wave, right? Nuclear and hydro capacity has been in short supply. And of course, right, the big one, right, the reduced flows across the Nord Stream 1 pipeline. And even as we speak, Nord Stream 1 volumes are running at 20% capacity. Gazprom has just announced unscheduled maintenance, right, for 3 days at the end of the month. So it's really unclear how this is going to evolve over the coming weeks. And one thing's clear, right? Further announcements ultimately are going to drive significant volatility and large swings on the TTF one way or the other. Now, I think it's obvious, I guess, that Europe is going to go through a very rough winter this year. And I think in Wood Mackenzie's kind of European gas scenario, we've kind of modeled a variety of scenarios, right? So on the one hand, capacity potentially going back to 40% versus a zero capacity scenario.
Where you're talking in terms of the Nord Stream 1 capacity.
Indeed.
From 0 to 40.
Yeah, 0 to 40. So the bad news is that either way, right? However we kind of crunch the numbers, we basically come to the conclusion that Europe is going to run out of gas, right, by the first quarter of 2023. And that's just a question of, whether it's January or kind of March. Now, in some ways, the only way then Europe can save itself, right, is to basically max out everything it will have in its arsenal or its policy options, both on the supply side and the demand side. And we've already seen them obviously going ahead with a lot of the regas terminals, which and certainly the German ones are going to probably come first, right, by the end of this year, if you're lucky. Obviously drawing more on Norwegian and kind of Algerian pipeline flows. But then, of course, on the other side, on the demand side, we're starting to see gas and power rationing, and certainly the switch over to more coal generation. Now, I think the latest
What about switch over to fuel oil generation? Is that going to be of scale from your forecast?
I think that's happening a little bit. I think, and the reality, of course, is for Europe, there's not actually that much fuel oil capacity, right? And so for, let's say, manufacturing plants or even utilities to switch over to that, there's a lot of kit that needs to be invested in. Now, if you're talking about what, $70 or $80 per MMBTU gas price, I mean, to put that in oil terms, right, we're talking about what, $400 to $450 per barrel. I mean, it feels like a no-brainer, right, to kind of switch over to oil. Unfortunately, it does take time, right, to make that switch. And, winter's coming out very quickly. So I fear that at least for this winter, it's really going to be a winter of discontent to some extent. Now, having said all that, now in the best case scenario where Europe's able to maximize, LNG imports and do all these kind of demand side management, measures, storage might just about make it right to the European Commission's 80% target, by, let's say, the kind of start of winter, so November the 1st being the cutoff date. But anything below that, right? Anything below that, it's going to be catastrophic, right? And in our modeling, we would suggest that almost 30% of industrial capacity will need to be curtailed if Europe is not able to kind of meet its target. So,
sorry, you said 30% of industrial capacity in Europe, the European Union.
Correct.
Wow.
We're already seeing some of that happening, right? I mean, every day we're seeing like factories shut down. I mean, smelters, aluminum smelters, zinc smelters. It's starting already. I mean, I think the thing that really brought it home to me, I was on LinkedIn the other day and I saw this photo, right, that someone took. It was of a smelter's utility bill, which kind of went from, 120,000 euros same time last year to almost €1 million this year. Now that's almost an 8-fold increase, right, in the space of a year. There is no business out there. It doesn't matter whether you're a bakery or a smelter that can restore in a shock like that. So it is really dire. And the bad news is that going to 2023, it's not clear, right? I mean, should Russian flows really stop? Our estimates would suggest that Europe could be drawing down, further 40 to 50 extra million tons of LNG. And this is where I think the Asian angle comes in, to your initial question. A lot of that head-to-head competition that's going on between Europe and Asia now, right, is really driven by Europe at this point in time. So the logic of global gas flows has really been turned on its head. Assuming that the Europeans are still able and prepared to pay for these prices, that's going to just suck out all kind of available spot volumes out of the Asian market, right? And
can Asian compete at those prices? Can Asian countries compete at those prices?
No, I don't think they can. I think maybe with the exception of maybe the kind of Northeast Asian economies, maybe Singapore. I don't think anyone else can. Like certainly when we're seeing the adjustments happen quite rapidly across Asia already, right? So China spot demand has kind of tanked, right? And overall year to date, LNG imports, right, in China has dropped by 20%. In India, it's down by 10%. So
even with this crazy heat wave in China, LNG demand is dropping. I don't understand those two pieces.
Okay, so I think the difference with China and in fact India is that for both of these nations, they do have fallback options, and I think coal being the main source of fallback here, not only in terms of domestic produced coal, of course, which has been ramping up right very quickly. You know, India has just taken almost 100 coal mines, right, which are previously mothballed out into production again, and same thing in China also. I think China also has had the luxury perhaps of contracted LNG, which they're obviously still bringing in. But yeah, you're right, because I think the hydro thing, which has been very quite recent, if you like, that is certainly going to be drawing down on potential gas in the short term. And so there's a real worry here, because I think going into the tail end of this year, if China somehow says, right, there's not enough coal in the market, I can't do enough hydro, right, because the heat continues. I can't find enough coal in the domestic market. Guess what? They're going to be back into the spot markets again. And then
does China have the ability? Do they have a interconnected national grid? I mean, some areas that are heavily dependent on hydro, can they get electricity from other areas that have lots of coal-fired power?
I think that's a possibility, of course, but of course, again, within constraints, right? And if you think about the heat differentials within the north and south of the country, at present the heat waves are all largely in the south, like Shanghai and below. But going to winter, it's going to be the northern part of the country that's going to be really kind of drawing down on gas. So I think our estimates would suggest that Chinese gas storage levels are reasonable for now. But again, that's not to say that it's going to stay that way forever. And I think also some of it, I suspect, is politically driven, because if President Xi, for example, says, all right, we're going to have to change tack here, right, given the state of the economy, and start maybe reopening and maybe relaxing some of the lockdown measures. Once Chinese industrial capacity, right, starts humming again, you can be sure, right, that gas demand is almost going to shoot up again, and therefore that's going to be really dire, right? With Chinese spot demand coming back on, they'll be competing against, let's say, the Japanese or the Koreans, and then of course Europe, right? So it's a massive conundrum. Now, current $80 per MMBTU, I can't imagine where prices are going to go after this.
Do you, in that sense, you're saying, I mean, you obviously made a very good argument, and I think it's quite known that Europe is facing a winter of serious discontent, but it sounds to me Asia is as well.
Absolutely. I think it's Northern Hemisphere all around, and that pain inevitably spreads to the rest of the world, because I think already we're seeing that places like Pakistan, Bangladesh, very extraordinarily reliant on gas and LNG, right, to generate electricity. They can't get enough electricity, and then you see the political and social economic fallout from that already happening.
Is US in a position to be the big winner here? The US?
I think from an investment standpoint,
are not ready.
Yeah, but you're right. I think the short answer will be not ready. I think it will take time for US export capacity to ramp up, right? So, and they may be able to ramp up faster than other regions. And so over the kind of short to midterm, right? And I'm talking about the period to 2025, 2026. There are only two real winners here, right? It's Qatar and basically the United States. But specific to this winter, that is still going to be a really rough ride for everyone.
When you look at the sort of developments in the LNG markets in the sort of obviously pre-COVID, pre-Ukraine, the commitment towards, certainly in Europe, towards onshore LNG regasification plants was very limited, and Germany in particular were very negligent. But also in Asia, there's been a reluctance. Pakistan is still unfloating LNG, Bangladesh is still unfloating. Do you see now in this new wave of gas, unprecedented prices and demand, that we will see a push towards more fixed investment into fixed infrastructure onshore rather than floating? Or what are you seeing in the future on that?
Yeah, I think that's an interesting question. I think, and it's something that maybe hasn't quite been decided yet, I think, within the industry. Because I think if you think about the merits of the floating option, right, it's obviously fast and you can deploy it quite quickly. And that's some sense,
if you can get one.
If you can get one, exactly, right? So now we've I think in more normal times, right, for a lot of countries, a floating facility was always like, it's almost like trying before you buy, right? And you would, put something in relatively, kind of 3-4 million tons, right? And you could kind of try it, and then, just like in Pakistan and Bangladesh, then ultimately, if you kind of decide you need more gas, then you could then scale up with a much, with a fuller onshore terminal. My view would be that model is still very much in play, and I think especially for kind of new importers, right, that feels like a good model to be going with. And in some cases, right, you've seen in Argentina and the UAE, for example, kind of their gas demand needs actually fluctuates over time, right? So you can actually give up the option of the floater if you don't need it, and that kind of, especially for kind of some of the countries which actually have gas, right, it may be a good option for them. But I think what kind of makes the most sense will be really kind of country by country, right? So there's no one size fit all solution, I suspect, and project developers will basically need to do their evaluations quite carefully. And this also taking account the wider fuel mix within a country, which does evolve over time. So gas might be needed one day, maybe it kind of falls off later on, or maybe if it grows further, then again you start scaling up either then more FSRUs or indeed starting to go towards a land-based option.
I wanted just to finish off talking a little bit about the on the next point of that investment, the LNG piece on the receiving terminal side, but on the E&P side, the exploration and development of new gas, the East Med, Azerbaijan, West Africa or East Africa. What's your outlook for that? I mean, the Europeans seem to want to still have their cake and eat it. They want the security of supply and they want their energy transition. And so are not giving the security of like a 20-year outlook, more like a 5-year outlook. What's going to give in this equation in order to get these new supply opportunities to the market?
Yeah, well, I
very
think
expensive.
That is a really kind of multi-billion, multi-trillion-dollar question. I think
because it requires massive geopolitical commitment as well, right?
It does, and I think if you look at maybe Europe, right? I mean, you look at its place in the world today. Sitting on its borders, right? You've got the Middle East, you've got Africa, right? We're kind of neighbors to Europe, and in some ways the most proximate source of gas supply, right? Whether be that pipeline gas or
Algeria is already a huge supplier, of course. The Ceyhan pipeline out of Central Asia.
Central Asia, I think. I mean, amazingly, Qatar obviously being the 800-pound gorilla here, right? And even though most of Qatari volumes currently end up in the east, going forward, right? When kind of North-East, South come on stream, right?
But the big argument there between Qatar and Germany is Qatar wants a long-term commitment. Germany wants a short-term commitment. Where, that equation is repeated on many fronts. What gives there?
Yeah. Well, I think that's a great question. And I'm not sure I have all the answers to that one. To be honest, our outlook for Europe would suggest that, I mean, European gas demand ultimately will decline over time, right? Kind of, in our estimate, right, we kind of project maybe almost a halving of demand, right, going out to, let's say, the middle of next decade and across the EU. So in some ways, I mean, you can understand the reluctance of European buyers to sign up to long-term contracts because, you could be significantly out of money, especially in this environment, if you're not careful about these the contracts. But at the same time, I mean, I think the European buyers and utilities and governments, in fact, have to recognize that if you want more capacity, this capacity needs to be funded, right? And just relying on China to, just relying on China to sign SPAs isn't going to quite cut it. So I think ultimately, maybe the solution might be, okay, fine, maybe we're not talking about 25-year contracts or 20-year contracts, but 10 to 15-year contracts will at least help to anchor. That, and maybe we're already starting to see all that. We've seen obviously some, EMBW and ONG, for example, recently signed up to long-term contracts, like small volumes albeit, but maybe that's the spigot's kind of opening up. And that may then spur more European buyers, like give them more confidence to basically take that to sign up to those kind of longer term contracts.
Just on that sort of point of the point you made earlier vis-a-vis Nord Stream 1, 0 to 40% potential capacity in the coming period. ultimately, what does Russia do with their gas?
Well, I like to think that, okay, I mean, to the extent that international sanctions, right, don't kind of spread globally, my view is that there's still going to be an outlet for their gas, right? China is obviously the most proximate one, but I think India also, and we're already seeing that not only in gas but oil and coal also. So I think to the extent
you can see oil and coal because it's somewhat fungible. You can put it on a ship and send it. Russia doesn't have that network. I mean, for the interim period of time, if it doesn't supply that gas to Europe, and ultimately if Europe stops buying it, and both of those things seem to be happening one way or another, the 3 to 5 year outlook, Russia is going to have to find new markets for its gas. It's going to have to start building big pipelines to China and so forth. How do you see the future of those flows?
Yeah, so I think definitely, right, pipeline to China, I think, Power Siberia, 1, Power Siberia 2, I think that's, to me, almost a given, right, that these are projects that will go ahead. I mean, in some ways, I think the Russians are already, even before the Ukrainian invasion, they were already pivoting east towards China, right? Mainly because China is obviously a more price-sensitive market than Europe, but at the same time, it does offer the potential for very big volumes. So I think a lot of that pipeline build-up will happen, I think, in the coming decade, especially if you look at from a geopolitical standpoint, right? Both countries are obviously getting much closer to each other. I think the one thing I'm watching very closely is like, will at some point, both countries decide to go off the US dollar, right? I mean, that could be an interesting one in terms of just changing a lot of international financial dynamics, right? In terms of
I find it difficult. I find it difficult to believe, although you can see my enemy's enemy is my friend, that China builds its future on a partnership with Russia. That seems to me, for a country that is incredibly sensitive to security sensitivities and volatility sensitivity, putting their a lot of eggs in the Russian basket, becoming a new Germany, who now are paying the price of a really naive calculation of overdependence on Russia. China would want to, I would imagine they're looking at that and going, ooh, as much as we love Russian gas, I don't know if we want to become another Germany. But perhaps that's for another day's conversation, as we need to wrap up this week's halftime talk. It's a real pleasure to have Valery Chow, Vice President, Head of APAC Gas and LNG Research at Wood Mackenzie. Thank you, Valery.
Thanks, Sean. Thanks for having me.